So for this week's video, I want to talk about the Smith Maneuver strategy. Now this strategy has been around for a long time. There are already a lot of articles and video online talking about this strategy. However, a lot of the subscribers have asked me if I could explain this in my own words because they weren't quite able to understand fully what this concept is about and how to best utilize it. So today we're going to do exactly that. I'm going to dive deep into what is a Smith Maneuver strategy and how you can use it. We'll go from the basic to the advanced version. And at the end, I'll wrap up by talking about who may want to think about it and what are some points you need to watch out for. Now, if you have been watching my videos, you'll notice that my background looks a little bit different than usual. That's because I'm traveling right now, so I'm spending time in the quarantine hotel. So for the next couple of videos, you will be seeing a hotel background. Alright, so without further ado, let's jump into today's video. So first, let's talk about what is the Smith Maneuver strategy. Now, this strategy is actually invented by a local, Fraser Smith, who lives on the Vancouver Island, and he published about this strategy on year 2002. Basically, the idea is you would go and get a refinanceable mortgage from your bank. Now, what a refinanceable mortgage is basically anytime you pay down your principal, that amount will be auto-converted to a home equity line of credit room for you to use to take it back out and reinvest. Now, usually this is not a default strategy, and that is something you need to ask your bank about or ask your lender about at the time of borrowing. And almost all lenders can do this. For example, Scotia have their STEP program, which is exactly what I just described. TD, BMO, RBC, they all have their own version. So you just need to ask, and they should be able to tell you whether your situation can qualify for something like this or not. So the basic concept is very straightforward. What we want to do here is every month, as we are automatically paying down the principal on our mortgage, it will automatically get converted to a HELOC room for us to use. And what we want to do here is pull the exact amount out every month and reinvest into our portfolio. Now, for this strategy, I would recommend you do mainly a non-registered account, so not TFSA, not RSP. And the reason why is because doing so in a non-registered account, the interest that you pay every year is actually tax deductible, so you can write off your income and, in other words, lower your total interest cost, which will allow you to have a better chance of breaking even with your investment. And as long as the average return you're getting every year is higher than your true cost of borrowing, which we'll talk about later, what does that mean? You are making more money on the side in the long run. And so what is the true cost of borrowing? Now, for most people, it's actually not the HELOC rate that your bank quotes you. Your real cost is actually lower due to the fact that you can write off your tax. So here's an example. Let's say right now, if you were to go outside and get a HELOC immediately, the rate is likely going to be prime plus 0.5, which is 2.95% right now. And let's say your marginal tax bracket right now is at 30%. So essentially what you're doing is, while you're paying 2.95% interest on paper, you're really getting 30% of that money back because you get to write off at your income tax bracket. So in reality, your true cost is actually 2.95% times 70%, which in this case will be 2.065%. That is actually your true cost of borrowing. And so when you invest with the HELOC money on your portfolio, you need to achieve a 2.065% return every year on average in order for you to break even and come out ahead. Now, with that being said, you may also notice that the higher income you are, which means the higher tax bracket you are, the more advantageous this strategy will be because your true cost of borrowing is lower. And that is exactly right. So as you can see on the chart here, I took BC for example. This is what the marginal tax bracket is looking like. At the highest, we are actually at 53.5%, which is an insanely high marginal tax rate. So let's say if you are someone in that tax bracket, and if your HELOC rate is 2.95% right now, your actual true cost is 2.95% times 46.5%, because 53.5% of that amount you will be able to write off on your taxable income and get that back. So your true cost in this case is actually 1.37%, which is extremely low and very easy for you to break even and beat every year. Okay, so that is the concept of Smith Maneuver. Next, let's look at why this would make sense for a person to think about. Now, let's say in this example, someone has a $500K refinanceable mortgage, 2% interest rate, 25% amortized. So what's going to happen is every month as he is paying down his principal with his mortgage payments, he's going to transfer the exact same amount that just made available in his HELOC back out for investment. And we're going to assume we do this every month for the next 300 months, which is also 25 years. As you can see, I've made a sample chart to calculate based on different average return per year. This is the end result. And of course, this is also assuming HELOC rate does not change over time. Now, I know this is not realistic, but for the sake of calculation of demonstration, we're going to assume this is the case. Now, as you can see on the graph, based on different average return, this will yield you a sizable return in your portfolio pre-tax. However, if we factor in the fact that you can write off your interest that you're paying every year, and I'm going to assume this person is at a 30% tax bracket. As you can see, the total profit before tax with the interest write-off, it's going to look even better than what we first saw. So as you can see, this is a simple concept illustrating the power of Smith maneuver. Now the return looks very attractive in this simple example, and the main reason is because you're actually leveraging at the end of the day. By taking HELOC out to invest, you are borrowing. So this brings me to the downside of this strategy, is when you are not making your true cost of borrowing, you're not even breaking even, not only are you not making money, you're putting yourself more in debt. So that's something we need to keep in mind, and that's something I'll bring up again and talk about at the very end. But next, let's move on to another scenario, and where we'll look at kind of a more advanced use of the strategy, and that's doing a lump sum swap. So this second level of the strategy is more suitable for homeowners who already have a refinanceable mortgage, or they can refinance right now and get one. Plus, they need to have some sort of lump sum investment already in their non-registered portfolio. What you can do here if you have both is essentially swap them to create a taxable benefit for your non-registered investment. So let me explain in detail how that would work. So let's say right now, same person, same example, 500K mortgage, with the exception that he has 200K in a non-registered account being invested already. Now let's ignore prepayment penalties. What this person could do is actually take 200K that he invests in and sell all the investment, put it towards his 500K mortgage, thus paying it down to 300K right now. Now the 200K that he just paid down in principal is immediately going to create a 200K of HELOC room for him to use. What he's going to do is take that 200K back out immediately and buy back the same 200K non-registered investment that he just sold right now. So now the situation looks something like this. This person is still owing 500K in total, but inside is different. It consists of 300K of his original mortgage plus a 200K HELOC. Now the 300K is not tax deductible because nothing changed for that part. It's still the same mortgage as before, but the 200K is tax deductible because he took that back out to reinvest into a non-registered portfolio. And also in this example, your cash flow would improve because in the old example, a 500K mortgage at 2% for 25 years amortization is $2,119 per month payment. This new example, the 300K at 2% again at 25-year amortization is going to be $1,271 per month plus the 200K HELOC, which you only have to pay interest at 2.95%. It's going to cost you $491 per month. Together, this new structure is only going to cost you $1,763. And the reason why your cash flow also improves in this case is because the HELOC is an interest-only borrowing. So you're not paying any principal for this 200K if you choose not to. Now, before we look at the numbers on the projections, you need to be aware of the fact that even though your cash flow improved on paper, in reality, you are actually paying a slightly higher interest in this case. Because the old case, you will be paying 2% at your 500K borrowing, but with this new structure, you're actually paying 2% for the 300K that you still have from before, plus a 2.95% on your 200K. Now, assuming a 30% tax bracket, your true cost of borrowing after tax write-off is actually 2.07% for your 200K. So as you can see, you're actually paying a slightly higher interest rate than before. So that's something you need to keep in mind. Your cash flow improved, but your interest cost is slightly higher than before. So if the interest cost is slightly higher than before, why do we still want to do this? We want to do this is because the key here is to invest the cash flow we just freed up for ourselves into the side portfolio in a non-registered account. And as long as we can get a higher rate than what the true cost of borrowing is, which in this example is 2.07% for the HELOC, we will be better off in the long run. So here on the screen, I have made another summary projection chart as well. And as you can see, if we just naturally let the mortgage pay off itself in 25 years, this is what the return will look like before tax according to different average return. And at the bottom, this is what it will look like if we factor in the yearly tax write-off we're able to get, assuming a 30% tax bracket. However, we don't really have to invest a full 25 years if we don't want to. An alternative to do this is if you want to pay off your mortgage sooner, you can actually find a break even in the middle where your total profit after tax will equal roughly to the mortgage amount owing. So you can actually stop this strategy in the middle, take all your profit, pay the tax, and then with the leftover, pay off your remaining mortgage. Now, let's take a 6% column as an example. In this case, your break-even is about 15 years. So that is the method 2 of doing a lump sum swap. Now, the final version, method 3, is actually going to be the most advanced one. And what you're doing here is combining method 1 and method 2 together. Before we move on, if you haven't joined my private group, make sure you click the link in the below, request to join. We have a lot of professionals spread across different fields. So if you want to ask questions, get some opinions, or get some exclusive content, make sure you join below. So let's say you are doing that 200K swap from method 2 right away. And then as you pay down your principal every month, you also do what method 1 is doing. Take that money back out and reinvest that HELOC every month as you free up the principal. So looking at the final chart with the same projection according to different return, as you can see, the result is even better than method 1 and 2 combined. And that makes sense because what you're doing is essentially leveraging even more than method 1 and method 2. So that's basically what is a Smith maneuver and how you likely can utilize it for yourself to build wealth in the long run or pay off your mortgage sooner. Now to wrap up, let's talk about some points that you need to be aware of. So first point is that leveraging can be dangerous. Like we said already, if you make money, you are magnifying your return. That's why it's looking so good. But at the same time, if you lose money, you're also magnifying your losses. So this is why when you do a leverage investment, you have to go a lot more conservative than you normally would invest with your own money. So here I would recommend you either do a conservative or a modest investment, at most maybe balance, but definitely not go growth or very aggressive, because you could really end up losing money and now you created more debt for yourself. Now, point number 2 is that the tax write-off, like we said before, works a lot better the higher tax bracket you are. Generally, in my opinion, I think a 30% marginal tax bracket will be suitable for you to start thinking about this strategy because it takes up a substantial amount in terms of borrowing costs, which makes your risk even lower. That's not saying that you can't do so at a 20% or lower tax bracket. You can definitely do it. It's just that the tax write-off you get is not as much, so your real risk is going to be slightly higher than someone with a higher tax bracket. So that's something you want to keep in mind. And lastly, this kind of investment and method, especially if you're doing method 1 or method 3, which require you to take the exact principal back out as a HELOC to invest, requires a lot of manual work and discipline. Now, you could actually make it easier by doing an automatic pack out of your HELOC account, but this is not going to be perfect because the monthly pack is going to be fixed amount, but your principal payment is actually going to increase over time for your mortgage. So you will start to fall behind on your actual withdrawal amount. But if you really are lazy or you can't keep up with that kind of discipline, then you can do this to at least have something going on. Now, the final point is you need to talk to an advisor and or a CPA before you put this strategy in place. The reason why is because it's way more than just tax write-off and investing your money. In reality, your housing situation might change in the middle. For example, if you sell your house, you do have to pay back your mortgage and your HELOC before you can cash out from your sale. And sometimes if you're upsizing, you might even have to sell your leverage investment to recoup that money back so you can move to another place. And that will introduce other variables into the equation, which might affect your plan. Usually, I recommend clients able to really commit at least 5 years before they decide to do something like this, just because investment can be very volatile and you really don't want to sell when your portfolio is down and losing money. You don't want to sell at a loss or else you just created more debt for yourself. So that's it. That's basically everything I want to talk about Smith maneuver. Now, what I want to hear from you is, have you done this strategy before? Or if you're doing it right now, how is it going? So let me know about your thoughts and your comments below. And also, if you like these kind of videos, I do upload them 8:30 EST every Tuesday. So make sure you like and subscribe to the channel. Click the bell button so you get all the notifications in the future. Alright, this is Jacky. I hope you found this interesting. I'll see you next week. Bye!